Loan level price adjustments, or LLPAs. What the heck are they and why the heck do we care? In this video, I'm going to explain what LLPAs are, the changes that just took place, and why they matter. Now, if you already know what LLPAs are and you've heard about those new changes and you're confused on why those changes were made, that makes two of us because they make almost no sense from a risk standpoint, and I'll get into that. LLPA stands for Loan Level Price Adjustment. The definition of an LLPA is risk-based pricing adjustments that vary based on credit score, loan to value, type of product, and various other factors charged at the time of origination. So by definition, it's all adjusting for risk. And so you would assume that at higher risk, you would have more adjustments. But what happened here is the government came in and made adjustments so that they're subsidizing from the low risk and giving it to the high risk. The easiest way to understand this is to not talk about interest rates, but to talk about uninterest rate and the cost associated with getting that interest rate. These price adjustments are in basis points or in loan costs. So on any given interest rate, there's going to be a cost or a credit. So for example purposes, let's just say the interest rate is 5%. That's the base interest rate with no loan level price adjustments. I know we're not at rates that are 5% right now, and that's hopeful, and hopefully I'm just putting it out of the universe and we see that soon, but I'm using that just as an example. So at 5%, there are no loan level price adjustments. And now I'll go into the grid and show you what those price adjustments look like. And remember, a point is 1% of the loan amount. So if it's a $500,000 loan amount, that's a $5,000 charge in that case. So on this grid specifically, these are the current loan adjustments that are going into place on May 1st. Now the crazy thing here is if you're putting 3% down, which is this less than 90% loan to value, and you have a 660 credit score, you will have the same loan level price adjustment as someone putting 20% down and with 720 credit score. So here's where the actual risk standpoint goes completely out the window. Why would someone with a 720 credit score putting more money down get the same interest rate as someone putting 3% down with a 660 credit score? Basically what they're doing is they're charging the person with the good credit and then they're giving it to the person with the bad credit and the low down payment. But the positive news here is they did make huge adjustments to those lower brackets, and it will give first-time homebuyers a big advantage in this market. Now on this grid, what we basically did is pointed out the changes that are going into place May 1st that are impacting the current terms. So all this red in here, that's gonna be pricing that gets worse. So if you were at a 740 credit and you were putting 15% down, your rate is gonna get worse by 75 basis points or 0.75 in cost, not in rate. And then if you were putting 3% down and you had a 620 credit score, you would be saving 1.75 in points or upfront charge. So obviously huge gains for first-time homebuyers, and then it is pulling from the responsible, but they put in two extra things. They put in a debt-to-income ratio adjustment, and they also put in 2 extra credit tiers. So it used to be that 740 was the top tier credit of any interest rate. So didn't matter if you had an 800 credit score, if you have a 740, you're gonna get the best rate possible. Well, now they put in a 760 and a 780. So it's more important than ever to make sure your credit is absolutely top tier because it does pay. Back to this other grid, you can see it goes from 0.875 of an adjustment to 0.375. So it's a half of a point better if you have a 780 credit score versus 740. And the other part of it is the debt to income ratio. There's now a 0.375 hit for having a debt to income ratio over 40%. So normally there'd be almost no reason to know what loan level price adjustments are. It was mostly just common sense risk. If you put more down, you're gonna get a better interest rate. If you have better credit, you're gonna get a better interest rate. But with these changes, it's a lot more complex than that. And it's important to know this for a few reasons. One, for first-time homebuyers that might be discouraged about their credit score. As you can see on the grid, they're actually at a huge advantage now, and they're gonna get a lot better pricing. Two, if you have the client that comes to you and says, I've got the best credit, I'm putting all this money down, I get the best interest rate. That might not necessarily be the case because of these adjustments, and it's good to have that knowledge on hand. And then three, it's good to know these things so you can set your own goals around it. So you're gonna wanna look at getting your credit score as high as possible, keeping your debt as low as possible, and then not worrying so much about saving for that down payment because you're not gonna get a huge advantage of the rate by putting more down. Now to recap, these changes go into place on May 1st, and it goes from a straightforward risk standpoint to a subsidized risk standpoint, and this is cost, this is not rate. So when you're looking at this, don't think interest rates at all. Think the cost for that interest rate. Now, when you're thinking of points, it is helpful to note that if there's a 1-point charge for a rate and you don't want to pay a point, you would take a higher interest rate, and that's subject to market. It's not like a 0.75 means 0.25 in rate. It's not as simple as that. Interest rates are packaged up and sold on a secondary market as a mortgage-backed security, so one interest rate might have a way better cost than another one, and I'm going to get into that on another video. I hope you find this information helpful, and I hope I didn't make it too confusing for you. I put a link to the Fannie Mae loan level price adjustment so you can check that for yourself, and then if you want a copy of that grid, I can send that grid where it's green and orange and you can see the differences that go into place on May 1st. Just shoot me an email at matt.weber@fairwaymc.com and ask me for that grid. If you have any questions at all, my contact info will be at the end of the video, and please like and subscribe. Thanks.